Walk into Liam's house and you immediately feel something. It's not big, 4-bedroom, colonial, decent neighborhood, nothing that makes your jaw drop. The kitchen has the same countertops it had in 2019. His car is a 4-year-old Camry he paid $31,000 cash for and plans to drive until something important falls off. He works maybe 44 hours a week, takes 3 real vacations a year, and when the market dropped 28% in 2022, he went for a run, came home, and didn't check his account for 2 weeks. Liam is 46. His net worth is $1.84 million. Now, walk into Harry's house. Harry lives 3 miles away. He leases a $72,000 BMW renegotiated last year into something more practical. His kitchen was renovated in 2021 for $47,000. He has a brokerage account with 6 stocks he genuinely believes in, a home worth $850,000 that he can't sell without torching his 3.1% mortgage, and a financial life that looks extremely successful from the outside and feels genuinely precarious from the inside. Harry checks his portfolio when markets move. He works 58 hours a week. He earns more than Liam most years. Harry is also 46. His net worth is $312,000. Same city, same starting income, same decade. One of them built wealth, one of them funded the appearance of it. This isn't a video about how to start building wealth. It's about every specific trap waiting for you once you already have some. The ones that are completely invisible when you have nothing and become brutally expensive the moment you do. My name is Nick, and I spend way too much time studying why people who should be financially free end up financially stuck. That's something you want to avoid. Make sure to subscribe because we're going through every single one. Trap 1, lifestyle creep and why it gets worse the more you make. Let's start with the one that's already happening to you, and you probably haven't fully clocked it yet. Goldman Sachs surveyed over 5,000 Americans for their 2025 retirement. And buried in that data is a number I keep coming back to. Among households earning between $250,000 and $500,000 per year, roughly 43% report living paycheck to paycheck. For those making over $500,000, it's still nearly 40%. Nearly half of people making $500,000 a year have almost nothing left over. Here's what makes this genuinely strange. It's actually worse at the top than in the middle. Households earning $200,000 to $300,000 only reported a 16% paycheck to paycheck. Something doesn't just grow on the way up, it accelerates. And that something is your standard of living, quietly consuming every dollar of every raise before you even notice it's gone. There's something called the Ditto effect, named after a French philosopher who received a beautiful scarlet dressing gown as a gift and ended up in debt replacing his entire room's furniture to match it. The desk looked shabby next to it. Then the chair looked wrong next to the desk. Then the rug. Then the art. He called it the dangerous new companion. Economists call it consumption cascade. Your brain calls it, I deserve this. And it doesn't stop until the money does. You upgrade the apartment. Now the furniture looks wrong. You fix the furniture. Now the car is embarrassing. You fix the car. Now the neighborhood doesn't match. Each purchase is individually justifiable. Collectively, they consume your entire net worth growth every single year without ever feeling like overspending. The fix is uncomfortable but simple. When your income goes up, your savings rate goes up first, before the lifestyle catches anyone. If you get a $15,000 raise, $8,000 goes into investments before you feel a single dollar. That one rule applied consistently is probably worth $400,000. And if you don't apply it, Goldman Sachs' data suggests you'll find ways to spend $500,000 a year and still feel broke. Trap 2, over-concentration in a single asset. This one tends to hit people who've actually been successful, which is what makes it more dangerous, not less. And tell me if this sounds familiar. You bought something, a stock, a piece of real estate, the company's equity, and it went up significantly. You told a friend about it at some point, maybe casually, maybe less casually, and now you're in a relationship with this asset. It's part of how you think about yourself financially. Selling feels like betrayal or like admitting you don't actually believe it. So you hold and hold, and the position keeps growing as a percentage of everything you own. You are now technically gambling. You just don't feel like you are because it's worked so well. Intel was one of the most celebrated technology companies on earth in the year 2000. Not a speculative startup, a dominant, profitable business with real earnings. It peaked at around $75 a share during the dot. Within 14 days of that peak, it dropped 20%. Within 22 days, 36%. After revenue warning that September, it fell 40% in a single trading session. By late 2002, it was sitting at $12. That's an 82% decline. And here's the part that still gets me. It still hasn't recovered to where it was in the year 2000. Someone who held only Intel at the peak didn't just underperform the market. They've been waiting 25 years to break even. But Intel isn't the cautionary tale. Intel is just the one you can show on a chart. JP Morgan analyzed every Russell 3000 stock from 1980 to 2014, roughly 13,000 companies, and found that 40% suffered a permanent decline of 70% or more from their peak. In tech specifically, nearly two-thirds experienced catastrophic loss. The index returns look good because a small handful of extreme winners compensated for everyone else. You don't get to know which bucket your stock is in before you decide how much to hold. The rule most portfolio managers agree on: no single position above 10% of your portfolio. Most say 5% is safer. The attachment is the trap, not the asset itself. Trap 3: tax inefficiency, the slow bleed. Nobody notices. You had a great year. Portfolio up, sold a position that doubled. You're feeling good. Then March comes. You open TurboAx and you're staring at a number that doesn't make sense. You made $60,000 on that trade. You owe $24,480 in taxes. Not because you did anything wrong, not because of some audit, because you sold the position in month 11 instead of month 13. You owe nearly $10,000 in unnecessary taxes on a single $50,000 gain just because you were impatient. This is what tax inefficiency looks like. Not fraud, not complexity, just timing mistakes and placement errors nobody sat you down and explained. Morningstar found the average equity mutual fund lost 1.48% of its returns annually to taxes compounded over 20 years. That's roughly a 35% reduction in ending wealth. On a $500,000 portfolio, you're looking at $175,000 gone. Not too bad investments, not to a crash, to poor tax management. The most common mistakes: holding high dividend stocks and REITs in a taxable brokerage instead of an IRA. Every dividend becomes a taxable event whether you wanted to sell anything or not harvesting losses. When a position is down, selling it locks in a loss you can use to offset gains elsewhere without changing your market exposure. And selling before holding a full year is short-term gains are taxed up to 43.4%, 4% including the net investment income tax, while long-term gains max out at 23.8%. That 19.6-point spread cost you $9,800 on a $50,000 gain because you couldn't wait 2 more months. Taxes are almost certainly your single largest annual expense, bigger than your mortgage, bigger than anything else on your statement. The wealthy don't always earn more. They just make sure the IRS takes as little of it as legally possible. Trap 4: overconfidence after early success. Here's a trap that specifically targets smart people who have done things right, which makes it very effective. You had 2 good years. The stocks you picked went up, the real estate deal worked, the business grew faster than you modeled. And your brain very naturally files this under, "I'm good at this." Psychologists call it self-attribution bias. We credit gains to skill and losses to bad luck. It's not a personality flaw.